All right, let's get this webinar started. I want to thank everybody for being in attendance here and appreciate the time that you're dedicating to us. There's many options that you guys can spend your time on. So we're going to make this extremely productive. I may be caught speaking a little quickly. I apologize. But let me go through this process because I really want you to have the opportunity to see who we are, what we do, and how we can help you show ways to reduce your tax liability. So without further ado, let's go ahead and get going. This material is prepared for informational, educational purposes only, is not intended to provide and should not be relied upon for investment, tax, legal, or accounting advice. Okay, so our goal here is to help you reach your needs, your wants, by increasing your cash flow in the following ways. We increase your cash flow in the following ways by doing money efficient planning, appreciable deduction planning, which we're going to show you here today, and then another strategy we call exemption planning. So let's go ahead and talk about our approach, and our approach really is through an educational process only. We feel that as you're given the information and you're educated on the rules to the assets and the rules to the code, IRS code, then you should be able to make an educated decision with your various professionals. So now one of the things I want to make sure I make clear is that, you know, we all read books and we get knowledge and information, and one area that I found very helpful and to kind of talk about the very basics of rules to follow when it comes to money. And so Richest Man in Babylon was written in 1926, and really it's about 100 pages long, but it has some 7 rules that are extremely important. And these 7 rules lay out what our foundation should be. So pay yourself first. You've heard of that. Control your expenses. Earn a fair rate of return. So as a business owner, you're automatically focused and trying to control your expenses because you got cash flow you got to deal with, right? Whatever that overhead is, whatever your business is, and you're always looking to try to earn a fair rate of return. The other area is the rule is don't lose money. Now, please understand when we say don't lose money, many times people automatically go to investments and the stock market, that kind of stuff. No, don't lose money can mean multiple things. For example, don't have high debt, and that interest rate that's going to the credit card is losing money. Be cognizant of where you're spending your money. Remember, control your expenses. So don't lose money can be in multiple ways. Don't be foolish in hiring somebody. Spend some time. Get to know if that person is going to be a good person to fit your guys' culture in your business. If not, that costs money to hire people and go through that process. So there's multiple ways of losing money, but it's not rule number 4. Rule number 5 is own real estate. And some people look at this and say, oh, yeah, I own my house. And so through the planning process, if you end up engaging our services, you're going to hear us talk about your house being a liability, not necessarily an asset. And the reason being is that the bank considers your house a asset, and that's because there's typically a loan on it. Now, people will say, well, I have my house paid off. Great. Stop paying your property tax. See what happens to your house. So it is a liability. We'll show you how to turn it into an asset, though. Okay? But own real estate, protect your family, and then increase your ability to earn. We added an 8th rule, which we added reduce your tax liability. Now, the focus of these 8 rules we try to incorporate in every single strategy we will present to you guys. It won't be on this webinar, but if you engage our services and we present different strategies to you, our goal is to try to hit every single one of these rules into that particular strategy. Okay? So now, how did this all come about? Well, I read a book by Robert Kiyosaki, Rich Dad, Poor Dad, and I really enjoyed the book. And so, like with every good author, that you want to read another book of theirs. And so I bought his other book called Cash Flow Quadrant. And this book is what caused me in 2001 to become a advisor or consultant that I am today. So let's walk through this cash flow quadrant. And the top quadrant talks about being an employee. And now let me make sure this is very clear we understand this. We're looking at this from a tax perspective, okay? So keep that in mind from a tax perspective. An employee, you trade time for dollars. You earn an income that you negotiate with your employer based on your value and what you can bring and what they think is of value to you as well. Okay, and then the other part of the quadrant is being self-employed, where you still are trading time for dollars, but you are your own boss. There is no negotiating income here. You got to go out and earn your income. So instead of having a job like an employee, you actually own a job. Okay, so this side of the quadrant are the highest tax brackets there are. Okay, this is where you're going to pay the most taxes in these two quadrants here. Then if you shift over to the right side, you have business owners, which they have a system. And basically, they have employees. They're building a widget. They're offering a service. They can go away for a week or two, and typically their business is still going to sustain itself, if you will. Revenue is still going to come in. But being a business owner from a tax perspective, you have a lot of benefit, a lot of tax benefit, a lot of deductions, and we'll walk through that a little bit today in this webinar here. But business owners hire employees. Business owners hire taxpayers. Okay, you're going to hear me say that multiple times as you engage our services. But all three of these quadrants do and try to strive to be an investor. Whatever that means to each of the quadrants. I know what it means to us as consultants and what we're trying to accomplish in the investor world. But when we become an investor, our goal is to have compounding an asset that is compounding, okay? Now, an asset is something that is returning something to you. So in order to invest in something, you want it to be an asset, you want it to return something to you. So as that's returning it to you, you have what we call compound interest. Now, one of the things that Robert Kiyosaki and his team of professionals talk about is there's a moment where you have so many different streams of income or streams of assets compounding that your velocity of money is increasing. Okay, and so we're always striving to increase the velocity of money. Okay, so when it comes to the planning process, though, there's three bubbles that basically everything boils down to. Family planning, which is basically traditional financial planning. Business planning, we typically find people in this business planning area tend to be the guys who are offering 401k plans or offering commercial insurance. Okay, there really is not a lot of planning beyond that. And then both of these bubbles are looking for legacy or succession planning. So we've done a great job of planning how's that going to be passed on to our heirs or a charity or our alma mater or whatever. Bottom line, all these work in conjunction with one another. They all affect each other. And so we got to take it in strides. But they're all affected by what we call economic termites. So before we talk about what economic termites are, what is a termite? That's right. A termite is a little bug that eats away at wood, right? And usually you know you have a termite problem when? when it's too late, right? The problem has already already occurred, right? So economically, we have the same thing. We have termites that eat away at our wealth. There's four major termites that we focus on. There's more than that, but there's four major ones. The first one is taxes. The second is inflation. The third is time. And the fourth is regulations and laws. Okay, we always start off with taxes because taxes tend to be something that we have the ability to control, because the IRS is not our adversary. The IRS is like Papa or Big Brother. There's certain rules laid out, right? And if you're going to go touch a light socket as a kid, Papa's going to slap your hand and say, don't do that. Okay, and there's a reason. They're trying to protect you. The IRS is our adversary. They give us a guide. They give us a map. All right, but it's our job to be the GPS or hire a GPS to tell us how to get from point A to point B. Okay, and when we save on those taxes, those dollars are like having a guaranteed rate of return. If we're in the 24% merit tax bracket and we save money from taxes, that's a 24% rate of return. That's money that's returning to our pocket that would have normally gone out to the tax man. Okay, the IRS wants you to use these rules. They just want you to use them. They don't want you to try to deceive and lie and cheat. Okay. So we use the taxes to prepare ourselves for inflation, time, laws and regulations, and the other economic termites that are out there. Okay, so one of the thank you gifts we're going to give you is a white paper that we put together called Economic Termites, and it's going to go over the history and kind of some of the planning ideas that is incorporated in this webinar is also incorporated in this white paper. So that's a thank you for spending your time with us today. So when we started developing this planning process, and over the years working with business owners, I realized that as a business owner, there is no separation between you and your business. Okay, when you make a personal decision to go on vacation, it's going to affect your business. If you make a business decision, it's going to affect your personal life. This becomes more heightened and more aware of when there's an economic downturn. Okay, so when there's an economic downturn and business is starting to, we got to tighten things up, that affects us on both sides of the equation, as an individual, as a business. So we want to make sure that's very clear. We understand that there is a uniqueness with business owners, and that uniqueness is that we got to plan for the both of you. Okay, and we'll talk about that here in this analogy here. So in our planning process, we look at the planning process kind of like an oak tree. So we grew up learning that oak is a solid wood, strong wood, hard wood. But as you see here in the picture of the tree, it's very expansive. It's big, right? Now, as we were growing up, we would look at these oak trees and stare up in awe and amazement, and we'd ask Grandpa, how do we know how old this tree is? And Grandpa would tell you, well, you cut the trunk in half, and then these rings, see each of these rings represent how old the tree is. Okay, so we take this concept and we shift it a little bit, and we take it to a planning concept. So we consider you as the sapling. Okay, so you is the sapling, and you decided to start your business. Okay, so we added our first ring, and this first ring you set up as an S corp or an LLC or a partnership, whatever the case may be, but it provided some liability and protection of you, right? And then when you started your business, you had to have insurance, and that insurance created a ring around your business, which created a ring around you. So every time we add a particular strategy, it insulates you, the individual, the sapling, from the outside forces. And then as we go through our planning process, every strategy that we implement does the same thing. It's another ring that's added to insulate you, to protect you. Okay, so we see your business as a tool. You started your business years ago to for whatever reason, whether it was a hobby, or you worked for somebody and thought you could do a better job, or you just don't like working for somebody, you just wanted to be self-employed, and you all of a sudden became successful, and so now the goal is, through this planning process, is to treat your business as a tool. And this tool that you have as a business is a wealth building tool, because you have so many tax advantages available to you as a business owner. So we just want to be able to use those. So how we find that out is we developed and created a formula. And so what we do is we take your adjusted gross income. So if you looked on your 1040 personal tax return, at the very bottom line, line 37, as of at least the tax returns now, that says adjusted gross income, or you'll hear the term AGI. That's your taxable income. Okay, then we take your lifestyle income, or your living expenses, or you'll hear us say lifestyle expenses, basically what you spend your money on. Now, there's no judgment. We don't care what you spend your money on. Spend it to $2,000 a month in Vegas. We don't care. Gamble it all the way. We don't care. It's your money. What we do care about is what that dollar amount is. And the reason being is that when you subtract your expenses from your gross income, that equals what we call non-lifestyle income. This is extra income. Some people call it discretionary. We don't necessarily like that term, because we don't want it to be discretionary. We want to use it for a purpose, okay? So you have this lifestyle income that's not necessarily not needed. But what's happening is that every dollar of your non-lifestyle income is being taxed at your tax bracket. Well, why? Because your tax man, your income here is being left on your tax return. So what this means is you are paying taxes on income not needed for your lifestyle. So technically, you're just giving this money away to the IRS, right? Because you already told us what your expenses or your lifestyle income is. So if you have leftover, clearly you do not need it. So what we do is we don't find giving money to the IRS unnecessarily as a good option, and neither do they, because that's why they give us the IRS code, so we have the opportunity to save money on taxes. They're just not going to show us how to do it. So what we do is we shift this non-lifestyle income from your personal tax return to your corporate return. Well, how do we do that? Well, let's use this income funnel as our example. Let's say up here you have all your income, and all your income goes down the income funnel, and it summarizes at your personal tax return. How's that look? Well, in the current tax form, it looks like this. So line 7 is your wages. So if you're an S corporation, your W-2 income is right here. If you're an S corporation, then you're going to get a K1 at the end of the year. That's your profit. And line 17, that's where that goes. Okay, so here line 17 is rental real estate. So if you have real estate income, royalties, partnership, S corp, trust income, that all flows here on line 17. Okay. Now, if you're a sole proprietor, line 12, Schedule C is where your income is. You only have a certain amount of type of tax planning opportunities available to you here. But all of this is your income. Okay. And so what we do is that we find if we have that leftover income, that non-lifestyle income, we shift it back up the income funnel as deductions. So let's take a look at deductions. As we go through this process, we found that there are two different types of deductions. So let's talk about revenue, because when we have revenue, we have expenses. Now the IRS gives us this gift. They allow us to take these expenses and subtract them from our revenue. And by these expenses, they give us the opportunity to save on taxes. Okay, so we technically could pay taxes on our 100% of our revenue, but the IRS in their infinite wisdom said, hey, you know what, every expense you have, let's write that off, so at the bottom you have profit or loss. Okay, which those expenses equal tax savings because we're not paying income tax on it. Okay, so where there are deductions, there's two types of deductions. So what we have found is that over the years, that tax professionals that prepare tax forms, like a CPA or an enrolled agent, or maybe an in-house accountant, they're very good at doing the tax forms and tax documents. And what they're doing is they're giving you deductions, and the non-depreciable deductions are office furniture, office supplies, company vehicle, that sort of stuff that it's an expense, it is a tax savings, but something that does not appreciate in value in year over year. So next year that desk will not be worth more. Okay, those office supplies won't be worth more. Now all those are needed, so you're going to need those, absolutely. But what we find is that most of our clients, CPAs and enrolled agents, stop there. Because when it comes to tax planning and tax reduction planning strategies, there are specialists and certain specialties that understand certain parts of the code. So if there's non-appreciable deductions, then we can deduct, use the different definition of that, as appreciable deduction. Okay, when there's balance here, yin and yang, left, right, top, down, right? So appreciable deductions are deductions, they're expenses, they're tax savings, but they grow in value. So instead of having $1 today, tomorrow you're going to have $1.10 or $1.30 or $1.50 or $5, whatever the case may be. Okay, it appreciates and grows in value. So the question we ask is, which do you prefer to have? Not which ones do you like, but which ones do you prefer to have? Obviously, everyone says appreciable because you want your money to continue to grow. We talked about that, the compounding of assets, right? And the compounding of assets create the velocity of money, okay? And this is an area we do that in. So when we have revenue and income, that basically can go down a couple pathways, right? It can go down a taxable pathway or a tax deductible pathway. And either way your revenue or your income goes, it can go down those pathways, can each be in a pathway of tax deferred. Now there's an exit strategy here, and you have two strategies that you can exit. You can have taxable income or you can have tax-free income. So the question that we ask is, which would you prefer? Would you prefer taxable income or tax-free income? Of course, everybody chooses tax-free income. So we just found out that you would prefer appreciable deductions and you would prefer tax-free income. Okay? So let's go through this process and look some more. Excuse me. So let's look at an example. So we have our adjusted gross income. Let's say there's this business owner has an income of $500,000 and their lifestyle expenses are $300,000. So that means they have a non-lifestyle income of $200,000. Now what we do is we represent as what we call an opportunity cost. And what the opportunity cost is that you're doing A. You're doing what you're doing today. We're going to call that A. All right. Now you could be doing B, you could be doing something else, but you don't know what that's going to yield, right? And so that's what a lot of times we consider an investment, right? Or as a business owner, do I buy another truck to help our business? Do I hire another employee? What's going to be the return on that investment? Right? That's opportunity cost. We really don't know what that is. We can guesstimate. So what I'm going to show is I'm going to show you a guesstimation on this. Okay? But as a byproduct of this type of planning, what we end up doing is we create a tax efficient planning, we create wealth accumulation, and we create wealth diversification. These are what we call byproducts of this opportunity cost, byproducts of this planning process. So a great analogy or example to use is look at your last vehicle that you purchased. When you went to the dealer, I guarantee you there were things on your vehicle that you really didn't care it had. It made no big difference. You may even still not know that it's there on your vehicle, but it came with your vehicle. It was part of the purchase price. It just came for the ride, correct? So the same thing happens here. Is we're not necessarily looking for these things. These are byproducts of being more efficient with our dollars. Okay. And as a business owner, you want to be as efficient with your dollars as you possibly can. Okay, so one of the things we're going to offer you, if you choose to accept it, the Mission Impossible, is we're going to do a tax return analysis. And so what we do is we created this analysis where in this orange column we look at your tax return. We're going to look at your 1040 and your corporate return. So if you have an S Corp, we're going to look at your 1120S. Okay, and so we're going to list out the incomes here and the deductions and tell you what that scenario looks like on one page. Then we're going to also ask for a budget. Remember, we want that lifestyle income. We want to know what those lifestyle expenses are. And then by doing that, we're going to subtract the budget from your current plan, and that's where we're going to have our leftover, our non-lifestyle income. So at the bottom here, we're going to have our total of what we actually have left on the tax return. So since we're using our example here, the income is $500,000 and $300,000 is our budget, and we have $200,000 of leftover income. Okay. Now we found our clients appreciated having a one-page side by side to kind of show where and how things are working. Okay. And we'll walk through this with you. So here's your 1040, and so we walk through this with you in that initial tax return analysis, show you where the income is at, show you where the expenses are at. Line 40 we'll talk about here in a second, and then what your total tax owed is. Okay, so line 40 is your itemized deduction. And you can find your itemized deductions on Schedule A. Okay, which is usually the third page of your return. Now, there's something called the SALT tax, and when I talk to a lot of business owners, they don't know what this SALT tax is. So I'm going to explain it to you. SALT stands for State and Local Tax. Okay, in the Tax Reform Act of 2018, or actually 2017, but it's effective 2018, what they did is they put a cap on this of $10,000. So in this scenario, you see income taxes, $81,000. So they're going to cap this at 10. So that means $71,000 is going to be left as income. So what does that really mean? This $81,000 was state and local income tax that you paid to the state. Okay, so let's say you live in California. This was $81,000 you paid to the state of California. The federal government used to allow you to take this total state owed tax owed to the state and deduct it as part of your tax return federally. Okay, now this is going to be capped at $10,000. So what happens to the other $71,000? That's right, it's taxable income now. So if you're in a 35% tax bracket, that could be another $20,000, $30,000 in taxes that you owe. Okay, so that's pretty significant change in the Tax Reform Act, and this just goes through and explains what the SALT tax is. So now what we want to do is we want to talk about the federal tax bracket. Most people don't know how this works. It looks scary, all these numbers and brackets and all this kind of stuff. So let's walk through it. It's called a progressive tax system. What that means is that we have a income range. So let's say $19,000 to $77,000. So what happens is each bracket income range has a percentage. What this percentage is the tax owed in that bracket. So this 10% is owed on the first $19,000 of income. So if I make $77,400, that first $19,000 of income is taxed at $1,905. Okay, because I'm in the 12% tax bracket, I make $77,400. The difference between these two is taxed at 12. So I multiply that times 12%, and that's $7,000. You add these two up, and that's your total tax owed in that bracket, which is $8,907. And you keep doing it down through the progressive system. So if you're in a 35% tax bracket, your first $400,000 of income is going to be taxed at $91,000. Anything between the 400 and the 600 that is going to be taxed at 35%. Okay, so let's take a look at our scenario and our example here. So we have $500,000 of income. So here's our scenario. So the first 400 is taxed at 91. The leftover 100,000 from the 500,000 is taxed at 35%, is where the 35%. You add these two up, and that's where you get your taxable owed taxed income. Okay. Now, yes, there are certain deductions. There's giveaways, deductions, clawbacks, whatever you want to call it, and so it may be plus or minus this. Okay, but this gives you an idea of kind of a generalization of what this looks like. And now we're just talking federal tax brackets. We're not even talking about state either. So let's look at our situation. We said, oh, we only need 300,000. So technically, that 300,000 means that this 60,000 is all we should really be taxed on, because this other 200 we're going to shift off this return and put it on our corporate return. So that equates to $65,800 savings. So the question is, Mr. Business Owner, Mrs. Business Owner, what can you do with an extra $65,800? Okay, so let's see what that real value is. Let's look at that opportunity cost. Remember, I was going to tell you what the opportunity cost of your current planning versus what our planning is. So your current plan, let's say we do this just for 2018. You say, Bob, we're going to do this for 1 year. And we save you this $65,000. Let's assume there's a 20-year period that this money can appreciate at 5%. So you have your 20 years at a 5% appreciation compound. So that $65,000 is really worth almost $175,000. That's pretty significant. But now we know we're not going to do this just 1 year, right? We're going to do this every year, because that's what we've done every year, is we've paid $65,000 in taxes. So let's say you don't engage our services. Everything stays the same economically as well as tax brackets. Your $65,000 over the 20 years at a 5% appreciation is now worth $2.1 million. This is what your current planning is costing you, $2.1 million. Okay? So let's let that sink in a little bit. All right, so now let's look at our planning. Notice we weren't talking about 65,000, we were talking about 200,000, right? The capital restructured. Over that, let's say we did it 1 year again, over 20 years at a 5% appreciation. Now it's worth over $500,000. Okay, that's that compound value that we were talking about. But again, let's say you guys say, Bob, we got to do this planning process, and we do this every year for the next 20 years at 5%. So that means your 200,000, this planning, you can yield $6.6 million. So the question is out of this $6.6 million, how much of this $6.6 million that we just have been able to create would you want income tax free? Yeah, exactly. As much as possible, right? And some of you are saying all of it, or some of you are saying, I want to save more. Show me 300,000, not the 200,000, right? So you got to get an idea of what the opportunity cost of what's happening now and what could be happening. Okay, so now I want to take a step further, because now I have a lot of business owners that say, well, you can't really help me. Our budget, our costs, our lifestyle is kind of fixed. And so I never thought that was a good response to me by some of my business owners. So what I did was I started looking at budgets. And I started looking at budgets, and I say, okay, if we're looking at this from a tax perspective, and people pay their personal budgets with their income, what is the biggest budget item that most people have? And usually it's their mortgage, right? So what we say is that, okay, so out of this $4,300 a month mortgage, I need to have income to pay for this, right? This is coming out of your personal checking account. So that means you have to have income that goes into your personal checking account that goes to the bank, right? So if we did planning, if we said, hey, we can show you a way to pay off your mortgage quicker. The reason being is that out of this $4,300, if you're in a 24% tax bracket, that means you're receiving almost $64,000 of income just to pay for your mortgage. Okay, so that if we're able to shift this, now you're in a 35% tax bracket more than likely, so this is even higher. But what this means is that if we were to pay off your mortgage sooner and you no longer needed this income to pay for a mortgage, that's a $15,000 tax savings. Now, most people are going to go, but Bob, I get to write off the mortgage interest on my house. And that, yes, you're right, that is correct. But is that mortgage interest more or less than this tax savings here? Now, this is at a 24% tax bracket. If this was a 35% tax bracket, is this more or less than the mortgage. So you kind of see how some of our personal budget items, like our student loans or credit cards, how if we pay those things off sooner, we no longer need that personal income, so we can shift that new income, that $64,000, back to the corporate return as deductions. The other part of the opportunity cost is the interest on that mortgage. If you did it for 30 years at 4.9, that's worth $728,000 that's going to go to the bank. By paying off sooner, and with our formula and our calculations, we're going to save you $400,000. So not only are we going to be saving you over $15,000 a year taxes, we're also going to save you $400,000 in interest out the door. Remember, don't lose money. Richest man in Babylon, rule number 4, don't lose money. That's $400,000 that we could have lost. What could you do with an extra $400,000? Okay, so what's your next steps? Well, your next step is to click on the link and schedule a complimentary 30-minute session to discuss your situation and see if this is a match for you. Ask some questions. See if we need to set up another time to dive in deeper. We'll give you next steps in that 30-minute session as well. Okay. Plus, you're going to have the opportunity to get your free tax return analysis. So during that 30-minute session, I'll explain to you how you can obtain that as well. And then, of course, that white paper on economic termites, we will email you as well. So just wanted to take this opportunity to say thank you so much for your time, for spending this time with us. I hope you have a great day, and please click on that link, schedule a 30-minute session, and let's see how our planning process can help you as well. Thank you so much.